Good morning. Hope you guys have a good week. And today it's another Friday. What happened with the U.S. market? Anyone knows? Yesterday. Exactly. I think SPX and Nasdaq dropped 1 to 2%. So it was really bad. So what happened with yesterday's market? It was about the jobless claim. The jobless claim. So let's say different website, Yahoo Finance, and let's see what happened yesterday. So this is futures. Of course, this is not what we want. And let's look at Bitcoin, 20,000. Not good. My friend recommended me to buy Bitcoin when it was trading at $60,000. Bitcoin, of course, it is expensive. $60,000, $60,000, and now it's $20,000. So S&P dropped 1.85%, and it was bad. It was not just and then Dow Jones 1.66, Nasdaq Composite 2%. So you can see like how crazy it is. How crazy it was. So let me talk about this this particular phenomenon a little bit, because this is important. Yesterday it was and then I'm going to open up another website that I think is going to be useful. So go to investing.com and go to economic calendar and look at the one from yesterday. So what happened was in the US market, 3 stars. It was the non-farm employment change. And then the most important thing is there's a beach book, and then it is the crude oil inventory drop, so the oil was up by a bit. But the key was this one, non-farm employment change. So it says there is a higher number. Expected was 200,000. So in the middle column, that's expected 200,000. Last term was 119. Now it went up to 242,000. What does that mean? That means more people get employed, especially non-farm. If they are farmers, so in the US, it's kind of it's quite interesting because they separate into 2 groups. One is the farming industry. The other one is non-farm payroll, and this one is non-farm employment change, ADP. And well, the good thing and bad thing is that it's a good news that the market is really strong. I mean, I'm sorry, it should be the economy is really strong. But when the economy is strong, that is bad for the stock market at this particular moment. I mean, if we switch this particular data into 2011, 2012, 2011, with this data, the market probably will go up by 3%. Exactly the same magnitude. But then if you see this thing here at this environment, everything flips. Market drop 2% because of that. So everything I just said was about the macro indicator. So make sure if you want to participate in your MPF or have a long-term investment strategy. And look at those statements. Especially if you are interested in the US market, then you have to observe what's going on with the economic cycle. So understand the economic cycle is important. Understand the business cycle is another thing, because if you, I hope you guys can differentiate these two. The economic cycle is about a country. A business cycle is about a company. A business cycle, you can have a really advanced or growing industry, a growing business. But the economy could be like a downward trend. So for instance, like right now, semiconductor business definitely is a growing business. So it can go up by quite a bit. But then when a growing business hitting by let's say deteriorating economy, then you have to think about like whether you want to invest or not. So it boils down to the first few lectures that we have, asset allocation. So it is not about stock selection, it's not about security selection, but it's about the asset allocation. If you are good at allocating to the appropriate asset class, then you can actually make a huge win. I hope you guys understand that. And in the past couple of lectures, I need to rush it through today. Because in the past couple of lectures, I have put so much emphasis into the right direction for you guys. So going from the macro view, the top-down approach, macro, industry, and then going down to the business level, the company level. And at the company level, there are so many different ways you can do. You can have the technical analysis and ignore everything. You just focus on the price and the volume, and that is the a quick way you can analyze a stock. But what I'm trying to pitch to you, what I'm trying to sell to you right now is about the fundamental idea. If you are able to grab the fundamental knowledge, the fundamental analysis knowledge, you win. I can tell you that a lot of my peer group, like a peer competitor, most of them they focus on the technical analysis. Few of them talk about the fundamental, but they don't have a concrete idea. You know what? In the past 3 weeks, I got pushed by several newspaper editors, and they asked me, give me an offer. The 2 sessions is in China, right? The China is actually still ongoing. I think it's going to wrap up in the next few days. They asked me, so what happened with the 2 sessions? I said, what happened with them? Do I give a fuck about that? No, definitely not. I don't care about like what they said, because when I run the statistic, every single in the past 8 years, every single sessions, I plot let's say the price change, the index change from 1 month, 2 months, 3 months, 6 months, 9 months, and a year. None of them can give me a correlation that, let's say, in the 2 sessions, if they want to focus in the technology sector, will the technology sector go up in the next 3 months, 6 months? No, there was not. I cannot find any correlation. I cannot find any statistic inference. It is almost totally unrelated business. So in this case, how can I give you a number when I have after the 2 sessions? There's no way I can do that, because the people will speculate, hey, the 2 sessions will focus on the internal consumption. Yes, I know that it's about internal consumption, but are you going to give me $100 coupon so I can use and apply to a specific restaurant? No, it is not like that. The government will never do something like this. That is actually stupid. Give you the money to spend to a specific company. That is a bribery. That is not even a free market capitalism. That's just totally biased situation. No, Chinese government will not do that. And if this is the case, then how can I relate a particular company to the result of the two sessions. It's impossible. So you have to think about the cause effect relationship. Think about this, and you'll be able to think about how the company can grow. I'll give you more example like later on. So one of course, like when you study a company, you looked into the financial statements, you looked into the income statement, balance sheet, and then all these things you learned when you were in year 1 or year 2, or even if you're accounting major. That's good. That's great. Actually, that's great. Because accounting knowledge is going to help you analyzing a company by a lot. And this is also one major reason I hate all of my peer group. It's because none of them have like a major exposure. Let me tell you this. The guy I showed that to you on the video earlier in this term, he was not even a business major. He was not even a business undergraduate. He was only like studying like the public services or something like that. And then getting a master's degree in UK for like 1.5 years, and boom, that's it. And then he becomes like he becomes the CIO of a company. That's why he cannot say anything that has the deeper knowledge of something. So I want you to have learn this. When you analyzing a company, you can look into all the ratios. So ratios are important. And by the way, in your sort of the final exam of the quiz on April 14th, so that's close to a month. There will be some very basic accounting ratios that you need to learn. Again, I'm not going to ask you something that is like folded out of the picture or on nothing on outside of the screen or the slide. As long as you attend the tutorial session from Eva, you will be able to prepare the quiz well enough. And I asked her to pretty much like tell you every single format that can be seen on the exam. The last time she may keep something away, but you know what? That something is actually it's also like spoken like so many times. So that is not a major concern. But whatever I said in the lecture, some of them will be useful, but a lot of them will be for your own good. So for Eva's tutorial session, that is the key. So make sure you attend those sessions, like especially in a few weeks. 2 weeks before the quiz. I explained to you like all these financial ratios, but I have not go into detail for those ratios because it is actually I'm not going to refresh your memory with this precious time because I want to cover more products, more assets with you. So all the financial ratios, accounting ratios, you can check out with your let's say basic accounting 101, the first accounting course that you have. I'm sure that you will learn that, but I'm not going to ask you like something like crazy. Some simple, straightforward, very popular, very useful figure will be questioned. So that's financial rate. And there are several ways you can actually analyze the company. So you can analyze the company by using the ratio. Some people will use the free cash flow. And there's actually another way. It's called the economic value added model, EVA. It was something I learned when I was actually at your age. There was a huge textbook called Evaluation. It was actually studied usually by typical MBA students. But my school actually put that in the senior year. So I was studying that textbook. That was the Bible. That was the Bible everything. I pretty much like drew into that textbook and study like in and out. I have no clue what that was, but I try to understand what's everything that it says here. The book is still with me. And that was a good book. And the book was talking about economic value added. So what is the meaning of economic value added? So basically, if you think about take a step back, you think about the entire business. You have raised capital. You raise capital from the debt, let's say borrowing from the banks, or raise the capital from the shareholders, equity side. And then you use that capital to make a living for your company. So let's say you have $100 for the capital. You make a living from that $100. Let's say you make $10 from the living. So 10% return, that's good. But the capital is not free. You need to pay for the capital, right? That's the cost of capital, which means that when you borrow from the bank may charge you 5%. When you borrow from the stockholders, they have expectations that is 7%. And at the end, you may raise debt from that market. That may be 6%. So let's say altogether 5, 6, 7%, you make an average of 6%. You're making a return of 10%, paying the cost of capital at 6%. That means you're making a 4% return. That's nice, right? 4% return. Think about this. Now you borrow $100. What if you borrow $100 million? What about $100 billion? Then that 4% won't be a small number. It is not as just a 4%. This is how we analyze this. So in a nutshell, in summary, another way to analyze a company besides the free cash flow is to dissect a company, putting all the income statement numbers and balance sheet numbers into the appropriate bucket, and then to calculate what is the cost of the capital and what is the return on the capital, and the difference between that will be the economic value added. I hope you guys will have that kind of sense when you walk out from this classroom today. You think about this: every single minute, every single hour that you spend, there will be a cost for you. Let's say if you believe that, hey, if I don't use this hour, maybe I can go outside and be more satisfied or be more happy, then you should do that. And this is actually exactly what I said in the first lecture. So I'm not asking you to, I'm not asking you to actually to come here, because if you believe you have a better place to go, a more value added in this 2 hours, then you should leave. But if you believe that you can actually earn or learn more, then you actually should stay. And that will be the cost and benefit analysis. This EVA is exactly the same thing. I know you may probably will not encounter this going forward, but just in case, bear this in your mind. When you go out to work, working with your supervisor or anything, whenever you go to work, you think about the cost benefit analysis. This will always help you. What is the total cost? What is the return, expected return? If you do the project, you will encounter this when you become a junior manager or something like that. So that will be at least a few years after you step into the real world. So Verizon, I'm not going to drill deep into that. Verizon is a company similar as China Mobile, but it's in the US. I'm not going to get into like all these details. I'm just going to give you a snapshot. So you have the cost of capital, the return on capital. Then you can now basically see that you're making 2.4% return. And if the capital base is $176 billion, 176 times 2.4, that's a $4 billion. This is the EVA. And if you ask, what is the company worth? Then this is actually the company will worth this much. Subtract, of course, like the debt holders portion, right? I mean, the remaining equity portion. This is how you calculate the EVA, and this is the list. So it is quite similar to the ones that you see from a free cash flow perspective. Of course, you haven't learned the free cash flow yet, but this is the EVA. I'm not going to ask you in the quiz, so don't worry about that. But I want you to know the concept. I want you to know the logic behind. For this, on the other hand, I'm not saying I need you to memorize the entire DuPont systems, but it is another way to look into the company, how the company performs. You have all different ratios. You have from return on equity, so NI divided by total equity, and all the way drilling into like different numbers. So this is actually pretty good on the return on equity, and then expand into like 3 different portions, and you can go ahead and check out the 5 factors that is actually quite relevant to analyzing a company. This is this website is actually pretty good. The East Money website. In China, they have this is Guanghei, and they have broken this down from the ROE and all the way down. But you know what? They make this chart really nice. But how many people can actually understand like every single bit of the information? No. I bet like the ones who create this probably will not understand how to use that. But this is actually quite useful. So I hope with the this DuPont system return on equity, break it down to 3 different parts, and then furthermore. So these are pretty much like all the ratios that you will see, but it may not be useful. What I'm trying to say is a ratio is good if and only if you understand how to use it. Because if you got a ratio, but if you don't understand what that means, then it's as good as a bad ratio, right? So try to understand the some ratios here. But again, don't worry. Before the quiz, we'll give you a list of ratios that unfortunately you have to memorize, but those are the ratios that will be actually quite useful if you stick along with the research or the investment universe. So this is actually just an example, a good company, and so one is a leverage company, the other one is no leverage, no debt, and you can see like the ROE and then all the ways like how these ratios will reflect the company situation. So this is a good summary, because everything is very theoretical, everything is calculated, and you can see with some debt, the leverage, let's say for the good year, you can see that 1.3, no debt will be 1, and you can see it's a 30% higher of that. But in terms of let's say return on equity for the bad year, ROE will definitely be better if you have no debt. So with this, you can sort of guess if the economy is not doing good. Let's say in the US, it's not doing good. Then what will happen now with these 2 different financial leverage companies? And you can guess which one will have a higher, higher chance to fall. So ratio analysis, there are 3 major ones. One is the profitability, the other is liquidity, and the third one is the efficiency. And people will have maybe 5, may have 5 major parts. So it really depends. But to me, ratio analysis will have at least 3 to 5 big categories. And with these 5 categories, you need to think about because sometimes there's no key major group that will stand out. So let's say if you have a really high profitability for a company, then they may have a really bad liquidity ratio. So there is no right or wrong, or which one is better, or which one is more important. It is not like that. You have to look into all of them all at once. So this is the art. This is the art. Let me tell this. A huge supermarket store in the US, Walmart. the profit margin is only 5% or 3%, like the bottom line. Does that mean that it's a bad company? No, it is not. Tencent, the profit margin, the bottom line, is around like 15-20%. Would that be always better than Walmart? No, not necessary. When market crush, Walmart is always the best. 10 cents is everyone would dump 10 cents. But when the market is flying, going higher and higher, then people will choose 10 cents rather than Walmart. But it doesn't mean that Walmart is a bad company. So you need to think about this. When you invest, a good company doesn't mean it has a good stock. A good company basically just mean a good company, and in the long run, the stock price may support or may grow. That's it. In the Warren Buffett evidence, he always buy good company because he doesn't hold it for like 2 months or even 2 years. He bought Coca-Cola for 50 years. He bought insurance company for 50 years. That's the long-term investment. So when you're adding the compound effect, when you are able to create the cash, let's say for Coca-Cola, if the management is able to generate the EVA, the economic value added, the larger the base, and then the higher the EVA spread, then the high value of the company. This is how we should do the long-term investment. Unfortunately, in here, what I'm trying to pitch you is about the long-term investment. But all of you sitting here, including myself, will be forced to make a very short-term decision. Sometimes it could be as short as few months, sometimes even day trade. But always remember, when you have money to invest, you put a lot of money in the long-term investment, and then you may put another 20% in the short-term investment. This is how you do the strategic allocation. You never ever dump everything into one pocket. So this is one investment advice I will use about it. So you have the ROE, R08, and all these. So I'm not going to drill into this. And this is actually a graph illustrating a tech sector. You will have a high profit margin. Computers, ROA will be good. Retail sector will be low ROA and then low operating profit margin. But it doesn't mean that it is actually bad. It just basically means it will generate the less revenue than the tech sector, but the stock may still be good. So this is just the ratio. And and probably you will ask, you will not be able to see the value from the ratio. The ratio may look nice, but you are not able to see if the value is good or not. So that's why once you run the ratio analysis, then you need to run the multiples analysis. When I said multiples, the most famous multiple you always heard, PE ratio, CM. But there are actually a lot more multiples you can use. EV, EBITDA, price to sales, price to book, price to total core equity. All these are multiples. So think about this situation. Again, ratios, financial ratios here will not be able to tell you if the company is worth investing or not. Is it expensive or is it cheap? No. Ratio will only be able to tell you if the company is operating a good or efficient or is it profitable. That's it. Not expensive, not cheap. It won't be able to tell you this thing. So when we run the ratio analysis, there are several. I think there are several categories. I'm not going to go into each one of them. But they will try to Well, actually not Dave, but you will try to see how the company operates in the business model. Let's say how quick they turn the inventory. Let's say if this is Leiling, Honda, all these retail companies, right? They have the inventory. If the inventory is turning like really good, so let's say one company turn over the entire inventory like 5 times a year. The other company only like turns 3 times a year. Assume they're in the same business. Then you know the 5 times definitely will have a faster sales, right? So that's good. So you try to detect any particular phenomenon from the region. So that's the that's the key. And on the other hand, liquidity. I want to see how much cash the company has at this point. And the cash be useful or just they hold on to the cash. Usually people will hold a minimum amount of cash because they need the cash to operate to pay the suppliers, right? So how about the suppliers and customers? You know, there was actually one of the my portfolio one of my partner, the portfolio manager. He was trying to analyze Amazon. That was back in 2010. And he found out that Amazon was actually not making money. But the problem is he found out that the not the quick ratio, but actually the current asset and current liabilities. Amazon was generating a lot of free cash flow. Even the net income was actually negative. But when he was actually using the free cash flow to evaluate that, he found out that the suppliers, when Amazon paid to the suppliers, it was over 30 days. But when he gets the money from the customers, Amazon gets it within like 2 days, 3 days. You're making a gap of 27 days. You know what Alibaba also makes money? Alibaba makes money not because of well, not only because of the platform they are selling. Is he selling any product? No, Alibaba is not selling any product. Alibaba basically built a platform, bridging the supplier, the manufacturer, to the customers. Supply, demand. He is just an agent. At the same time, he was actually running a lot of cash collection and then trying to delay the date. You know how much the company can make if he delays supply just one more day. We are talking about like multi-billion dollars cash on hand for one day. Imagine if I put this amount in work to buy some US overnight treasury. He is going to make a huge fortune, even though the return is going to be what 0.01% or 0.1%. It was huge. This is the major reason he start another company called Ant Financial, because he needs that to make a crush to the China financial system, China banking system, because he believed that his model is more effective, more advanced, and more efficient. And of course, I believe him. I totally believe him. But you are trying to affect the country's financial system. Do you think all these people will allow you to do that? No way. No way. No freaking way. But he was actually too aggressive. But he was way too aggressive. Well, he got burned. Of course, you know that in financial, we all speculated. IPO on that day, and then within 24 hours before the launch, and then suddenly got called off, and then he disappeared, and now he's like traveling around and nowhere to be found. He was in Japan, right? But you know what? The cash, the current liability suppliers, that thing is very important because it helped Amazon to build what Amazon now, and also Alibaba to become Alibaba like right now. So make sure you understand the ratios here. And another, this one is a little bit tricky, but it's still a ratio analysis, but then it incorporates some of the real market price element, and that's price to book and price to earnings. It is still ratio, but I will call this multiples because I want to differentiate these two. All this inventory turnover ratio, collection period, put ratio, the current ratio, all these are accounting ratio. When you get the number, it won't change for the next 3 months or even 6 months. That's ratio. This one in particular, it changed every single minute, every single second. Price to book, because the price will change, right? In this case, the price will change throughout the whole day. PE ratio, that's the same thing. So let's say, you know what happened with TVB? So the day before the Friday, Wednesday, it went up by 85%. The freaking this stock. I don't understand why this stock will went up by 85%. All they have was just include. I got invited by Alibaba and to do the online selling, something like this. Do you think it will push the stock price to 85% higher from before? It was trading at a discount. Let me tell you this: the stock may be trading at a discount, maybe discount by like 30%. But let's say if they come up with some kind of good strategy, do you think it will actually go up by 85%? And then yesterday it went up by another 20%? No way. Who ever creates this market? This is how the broker pushes all these people. A lot of fools, a lot of stupids, a lot of morons. I don't understand. They just listen to their friends and say, hey, you should buy TVB. It's going to make it higher. Yeah, you make another 20%. Yeah, you see, I bought it. It was let's say it was $10 before, and then I bought it at $15, and now I sell at $17, and the stock is still going up. There's no fundamental value. Can you tell me if there's any fundamental value here in this stock? No. I was actually shorting the stock. Well, I did it, but I hope I can, because the borrowing will be expensive. So this is how you should think about the fundamental. The ratios. Even if you build the financial model, does that mean it will always bump up by 85%, 100%? No, no way. So with all these ratios, PE and PB, all these accounting ratios, why do you use it? How do you use it? There are two ways you can use ratios. One is to compare yourself to the past self, which means you compare last year, you compare like 2 years ago, 3 years ago, 5 years ago. That's how you compare, use the ratio. Are you doing better than last year? Are you doing better than 2 years ago, 5 years ago? Are you see your profitability growing, expanding? This is how, and this is all the analysts, when they make estimate, they will compare the company to historical performance. Oh, the company is going to make another, let's say, a 2% improvement in the margin, 2% improvement in the gross margin. That's it. This is how they use the ratio. So compare to yourself. The second way to do it is to compare to your peer group. You think about yourself. So let's say you have a finance course for 4 years. I hope this will be the case. If I get a chance to teach, well, to show you 4 years, I'll split into equities, fixed income, options, and everything. Split into four terms. That will be much easier to jump everything into like 12 sessions. Then you are able to compare your grade. Is it improving or not improving? The second way is you compare your grade to your peer, your classmate. That's how you use your GPA. That's how you use the ratio. I call it benchmarking. You benchmark to yourself or you benchmark to others. So make sure you understand the how they use the ratio. when I compare stocks to stock, which one should I take? Should I take a Tencent or should I take Tesla? Then I will compare the margin. Of course, these two are two different companies. Should I compare Long Fu Sanqu, a water seller, to Tencent, a software company? No, the margins will be different. Well, actually, the margins is actually quite close. The guy selling the water is actually quite profitable. Anyway, you will compare within the industry. Software industry compare to software companies. Retail company will compare to retail company. Good. Benchmark is good, and then this is a summary of the key financial ratios, so KFR, and only 2 pages, and it is not going to be that hard if I ask you to memorize all of them, right? It's not going to be that hard, but there will be actually some quite important. I'll focus on. So, but this is only like 2 pages. Of course, I'm not going to show you. Okay, if it is this interest expense, this what is interest profit. It is not going to be like that straightforward. It will be like I show you an income statement, I show you a balance sheet, and then you pick up the numbers that you need. That will be the question. And then the comparability. Of course, like different companies, they have a different accounting system. And I am not going to go into this again. Some people use LIFO or FIFO. Hope you guys remember that. So last in, first out, first in, first out. How to estimate, how to evaluate your inventory account. And there are lots of different things. Depreciation, accounting, taxation, and all these reserving practices and intangibles and all these things. So I'm not going to go into all these, but just remember, different companies may have a different accounting treatment. So they're actually even with P ratio, price to earnings, price will always stay constant, right? Price is whatever price we have. But earnings can be reported or adjusted. So that becomes a problem, because if you find there is a big difference, you have to be very, very careful. Japan is a big problem because the intercorrelation situation within companies and companies, between companies, will make the earnings a very, very messy. So you have to make a lot of adjustments. So in the market, it's like this. If you know someone focusing on Japan portfolio, most likely he or she will stay like for the life, because no one else knows how to understand how to evaluate a Japanese company. Like for myself, I don't know how to evaluate that. It is a very messy thing. So another person you need to aware of, not Warren Buffett, but Benjamin Graham. So Benjamin Graham, he wrote a book called Value Investing. So you can actually read the book or do some search on the internet about his style, and his way of investing is actually much better than much better than typical technical analysis. So ratios and multiples. Seriously, these are all pros. All pros will use this. Any questions so far? What's that?
When you choosing the benchmark, should we choose the benchmark in the average company or average company performance or the
Average. So yeah, a question is asked. If we choose the benchmark, that is industry average. Should we choose the industry the best one, or should we choose the industry average? It is always the average. But again, I mean, by time with time, when you get more experience, then you will see what kind of average we use, because Of course, like there's only one average, but there could be a median you can use, or the top tier group that you can use. So it depends on how you want, what is your objective? Are you trying to pick the second runner, or are you trying to pick the industry champion? Then you need to think about your objective first. For that. All right. Let me. For actually I create that already, but I have not input the calculation. So this is your benchmark. So I got a 51% choosing SPX, 2% choosing Russell 2000, 4% choosing Dow Jones Industrial Average, 10% choosing Nasdaq Golden China, 22% choosing Nasdaq Composite, 12% choosing Nasdaq 100. Interesting. It seems like no one's choosing a picture or anything, but which is good because probably you can see if try to imagine yourself. Do you think this combination will give you a positive number or negative number in the last month? It probably will be negative. So everyone making a good return, or even zero return, will beat the benchmark. But yes, let me do the calculation for daily calculation for that. I haven't done that yet. Okay, so let's take a 5-minute break and we'll be back at 10 o'clock. Right.
是这个历史我是很发现到，我跟你说，跟你说会帮忙，跟你这个现在你什么？因为我每个都有。
I have a spreadsheet，我在我的 spreadsheet 上面是这样记的。
哦，
所以你不要担心，不要担心，不要。Am I doing this too fast? I already one section behind the schedule. If this is too fast, then
sometimes they don't and now
it should be covered by 3 courses, but not just 1 course. So there's no way I can put everything in.
no, I'm afraid of you know you applying our
Yes. Yes. If you can, that would be good. But if you cannot, I'm not blaming. You got some day traders here. But it's fine, it's fine. So assignment 2 is more like a getting an experience for the software. That's it. There's no
we achieved 20%.
yeah, don't worry about that. Yeah, if you lost 20%, yeah. Up or down. Try your best to do more.
I remember we need to be if we lose how to compare
Then if he got 0, then so let's say trade X is 0. Let's say 0%. If you're negative, then he lost that 1%. But it's not going to be that bad. 1% is not going to make the big difference. The key difference is good. That I can give it. The write up for assignment number 2 and the quiz. That's everything. Even the ICAs is not going to make a big difference because we have that experience before last year. People thought about ICAs and all this, but at the end it is the quiz assignment number 2. Number 1, everyone is doing a good job. It's not going to be a bad thing. What? That you have to count Eva. Because she was the one grading that. I don't know. I don't know. So then, okay, let's get back to this crazy thing. Equity valuation. I cannot believe again, I can only use half an hour to discuss with you what the entire professional world is doing, but I try to do that as deep as possible. So I have shown you what a ratio analysis and what the let's say bottom up. And this is actually the most wanted. When you do the fundamental analysis, then this equity valuation model is everything. How to do the stock valuation. So when you do the when you evaluate, when you use fundamental approach, this is the key. They will use information concerning the current and prospective profitability of a company as its fair market value. And then there will be alternative measures of the company's values, P/E ratios, and then these three things. P/E ratios is one part, which is the multiples. Second one is the dividend discount model, which I don't use that much, but people still keep using that. CDM and free cash flow model. That is the juice. Free cash flow model. If you go back to China, even in China, in Shanghai, all these stock analysts, they will just talk about like the free cash flow model, but how many of them actually understand what a free cash flow model is? That is actually going to be a big key difference. Of course, I'm not going to. I'm not expecting you to calculate what a free cash flow is, but I want you to remember the concept. Understand what's going on with the free cash flow. People talk about free cash flow all the time. If you want to become a pro, at least you talk like a pro. We talk about free cash flow. We never talk. Have you ever talked about? Have you ever heard me in the last I don't know 8 sessions? Say more than like a moving average more than like 10 times. Except that technical analysis chapter, I never use a moving average at all. Because it is actually not the way to invest. A fundamental analysis, we talked about this. We are going to use the quantitative analysis, present value approach, and relative approach. Present value is discounted cash flow. Relative value, that means you compare the ratios to the industry group or to the peers. Technical analysis, super easy. You just compare the price. SMA, EMA, RSI, Bollinger Band, pretty much it. That's pretty much it. Nothing else. If you believe technical analysis can win the world, then you should drill into it, but be a professional. Don't just draw 2 lines and then eyeball the target price. Don't be like that. If you want to be a professional technical chartist, then you be one. Write a program yourself, backtest the number, backtest the model, study the PowerPoint slide I gave you. I even spare like half an hour with something that is outside the syllabus. I'm not supposed to even teach you this technical analysis at that point, but I want you to understand, if you want to become a professional technical analyst, then you should actually follow this path, but not just blindly listen to someone else. If you're able to listen to that view in the first session, then you're going to lose a lot of money. I don't understand why these guys do survive, because it's impossible for someone to stay that long by luck, right? I mean, you have to have something to substantiate yourself, which is the fundamental knowledge. Or if you want to be a technical analyst, that's fine. Drill into that particular PowerPoint slide and be the one. Do the calculations. Understand all the indicators, the signals. That's very important. And if we are going into the fundamental analysis, then what we want is to find the intrinsic value. So there is an English term is intrinsic value, the true value of the company. It is not just stock price. Stock price times the let's say times outstanding share, but it is the intrinsic value, the true value behind. And this is what Warren Buffett always evaluates. When we looked at the ratio analysis, you think, hey, that's good enough. Whatever the book price says, the equity value, that is the equity value, right? No, the problem is equity value is the accounting term. We are looking at the past. What finance do is we look forward. We go beyond accounting. I'm not teaching you as an accounting major. I'm teaching you as a finance major. We look forward, we forecast. We will see how the management will become. And I'm going to give you a really good example later on in the next 20 minutes. That happened quite a bit. And actually your schoolmates early this year make a estimate, and it was right at the spot. And let me show that to you. So we use the book value, but that is from the accounting perspective, and that's not good. It's always has a limitation, because the market value will not just reflect on the from the book value. If every company is traded on book value, then I'm not going to stand here and teach you all this stuff, because everyone would just teach you, okay, well, look at the book value. If the book value equals to 1, then 1.01 times, then that's it, right? If that is the case, then HSBC will not trade at $60 because it is actually trading at a 0.3 book value. It should trade at least 3 times higher, $180. Do you think HSBC will always be trading $180? And if everything is trading on book value, then Tesla should not be at, I don't know, $600. Tesla should be around $60 because it is trading at almost like 30 times or 50 times of the book value. So this is actually not good to use the book value as the basis. And of course, people will use other terms, liquidation value. Assume you go bankrupt, you sell everything. Who is which one is the biggest the most famous company right now by liquidation? Evergrande, here. Chinese government basically forced it to sell everything. The CEO probably locked up somewhere, will not be released. I can imagine not in his entire life, because it's him causing all the entire trouble for the Chinese market. Why should I even let you go for the rest of the life? Impossible. He took a lot of leverage for his personal interest. That's not good. Not even from in terms of the socialism, but it's in terms of the capitalism. One person create huge mess and then the entire society puts up the burden. No, no one allows that. In the US, they will fail the company. Like Lehman Brothers, like Merrill Lynch, they failed the company. Company went bankrupt, and a lot of people lose money, lose their jobs. But that's how they get the penalty. In China, they will do the same thing. Another one is besides the liquidation value, people use the Tobin's Q. There's a specific formula for the Q ratio, and to be honest with you, I only see that on in theory. I've never seen that in real life. So probably this will come up if you go to liquidation or bankruptcy law or bankruptcy valuation. Because in my life I never go into one of those so I never use that ratio. The Tobin's Q is one of the ratios that you can use to value a company. But again, these two ratios are not for like the forecast, not for the company's future. So this is just FYI. If you looked at the Tesla situation, well, before that was $800. Now, of course, I think it's going up to $60. But you can see, you can compare this particular chart, and if you pull the chart right now, your real-time statistics, then you can see that there's a big difference between the book value and the PE ratio. So let's say the forward PE ratio, $82, right? $82. So let's pull out the ones right now. Do you think it's a higher PE or lower PE for Tesla nowadays? Anyone wants to make a guess? 50 times. What the hell happened? $800 last year now becomes less than 200. Does that make sense? It was around right here. So it was not $800. It has a stock split before. So what it meant, or what I meant by stock split was before it was $800, and then one share becomes 2 shares, and then half of it, so that will become $400. So it was around 355 at that time, and then now dropped to 172. So you can see you cannot just simply use his like the price itself to do the evaluation. Hey, the stock dropped like 80%. No, it is not like that. This one is before the stock split. And now the current price, $175, was after the stock split. But the key is it still slide from 350 to 172. So that was almost like 50% off. And you can see the PE ratio dropped a lot. Now it's now it's the PE ratio. The PE ratio is 50 times, but before that it was 80 times. So you can see how that dropped. How the financial ratio impact the stock price. Of course, if you want to evaluate a company, you can use all these websites. Yahoo Finance, those are actually pretty good. And in terms of equity valuation model, there are several models you can use. First one is CAPM model. The second one is let me go over one by one. Let's say the first one is CAPM model, capital asset pricing model. You know about this, you heard about this, you've done a lot of work on this. So that should be easy. And all I want you to remember is for CAPM model, capital asset pricing model, there is one factor, and that one factor is called the market factor. So how sensitive is the stock to the market? And if I tell you the stock is 2 times to the market, then if the market goes up by 10%, then you can expect the stock will go up by 20%. And if it's not by 20%, then you know there's arbitrage you can do. And this is exactly what you can think of: overpriced situation and underpriced situation. So you can see that the blue line is the intrinsic value. So everyone is trying to find the intrinsic value. But let me tell you this: it is extremely hard. Next time, I hope I can bring you something from Bloomberg. For let's say for all the analysts to estimate 10-cent stock price. None of the analysts in like 200 really good coverage analysts, okay, none of them will be able to expect the price will actually hit their target price. It's pretty much like never happen. There'll always be a gap. So intrinsic value and the market price can seldom be overlapped. This is just a theoretical situation. So CAPM is easy. You use one factor to do the projection of the expected return. Of course, you can be more sophisticated. French family model, the FF model, 3 factors model. You can be better. And it's still the same thing. If your intrinsic value is higher than the market value, you buy, and then this is the reverse, you sell, equals you hold. That's very straightforward, but it never happens in the real life. Then another model. So I want you to remember this. CAPM model, we use one factor. But if you are able to create a multi-factor, so let's say I'm running a research team. In the next one, I'm creating 8-factor model. 8 factor combining together to project the stock price or the sector move. That's the multi-factor model. So that I'm using the first approach, which is called factor model. MM is one of them. FF is another one. A second approach is called a different discount model. Dividend discount. You can use that, but no one really likes to throw it, because dividend is something that is controlled by the management, controlled by the CEO. I'm going to contrast. I'm going to make a difference between the dividend discount model and the ones that I'm going to tell you later on today. the fixed income model. Fixed income is the bond, right? They are actually very similar because in the dividend discount model, the formula is D divided by 1 plus R for the K, which is the required rate of return. Imagine if I don't show you D here, D1, D2, D3, I show you coupon, fixed income coupon, and replace the K by the coupon rate. Then this value is not a stock value, but it will become a bond value. So if you think about this, finance, it doesn't matter which asset class you are in. We are using the same model. This is the discount. This is the present value. This is the simple present value. So why people use the dividend discount model? Because assume, let's say you buy a stock. Assume every half year you will get $10 continuously at a growing pace of, let's say, 2% a year. Then you will be able to access or assess the value of the stock of the investment that you have. Because assume you know exactly like $10 next year will be $12, and then the year after next will be $14.40, and you discount all of them back, and then you will get that will be the value, right? The only problem is how many companies can guarantee you that they are going to pay exactly the dividend. No companies on earth will do that. So in this case, the DDM will be destroyed. Can HSBC do something like this? No, they stop the payment for like a year and a half by the government. The CEO has all the power to stop any particular payment. So whenever you heard a company stopping a dividend payment, there will be a huge discount for that. And let me tell you another company for that. So I hope you guys understand what the DDM is. And then before that, there are 3 different models. But these 3 different models basically is the same logic, same concept. 2 stage, 1 stage, or no growth, or 3 stage. It is exactly the same. Because all they want is actually all they did was adjust the D into a different growth stages. So it should be a fairly straight forward, simple present value model. And if this is a constant growth, let's see it's 1 plus G, right? Then the formula will be transformed from this long formula into a much shorter formula. All they need is D divided by K minus G. This is actually a very good formula, useful formula, not in terms of the DDM, but in terms of all the valuation items. So when I'm trying to evaluate a company, I'll actually do the free cash flow divided by cost of capital minus the growth of the free cash flow. And that's how I can actually calculate the what company value in my brain without a calculator. Estimate. So this DDM, constant growth, this is one particular subset. And this is an example for that. I'm going to give you so people will actually why people will use DDM is because people always talk about dividend yield. Dividend yield is the dividend divided by the stock price. It is the same concept as the coupon rate. The coupons divided by the price of the bond. That is basically a coupon rate. So they always compare the coupon rates to the stock dividend yield. It is always confused me because for dividends, as I told you, I give the money, I invest the money to a company, and you give me back the dividend. No, I don't want your dividend. I want you to invest more. You give me the money back to me for what? I give you the money to invest and you give me back the money. That's not how it works. So this is something I always emphasize. If you invest in 10 cents, I don't expect they give me dividends. If they give me dividends, that is actually a bad signal. Because it means that they don't, and they cannot find any particular area to grow. That's why they give me the cash back. And that's bad for me because I need to pay the tax on the dividend as well. And I need to find ways to reinvest the dividend. So that's not good. But then, of course, if you have some other companies, let's say utility company, a real estate investment trust, then you will get some dividend. Because that's the objective. That's the objective to get the dividend. So that's a dividend, a dividend yield. And of course, I just mentioned about the reinvestment. If you have a high reinvestment rate for the company like Tencent, then the dividend will be the dividend per share will grow even further. But if this is a low reinvestment, your dividends is actually not that good. And in that case, Tencent will have a higher stock price, expected stock price. And present value of growth opportunity. Basically, it's the same. It is the same formula, but they just flip it and change it and putting the G out and then and to see how much growth is priced in the company. So this is just a formula to tell you what is the growth. So if you put that in 10-cent model, this one it will actually be a very high number PVGO. If you put it in just some utility company, the PVGO will probably 0, even sometimes it's negative. So it depends on how much. It depends on the business cycle. Where is the company spent in the business cycle? If we are doing some, let's say, videotape business, I cannot think of any like disruptive business. So let's say before that, let's say, as I said before, if we are using the press button phone, mobile phone, that is a dying business. Everyone is using a touch screen phone. So in that case, we can see like the business cycle is going up or going down from the early years and so on. So these are the American companies, and you can see the technology ones, and then the utility ones. You can see the return on capital is much higher in the tech stock, and the growth rate is much higher, and the utility stock is actually much lower. So remember this: the price is low. It doesn't mean that it is actually bad. The growth is low, doesn't mean that it is a bad stock. So it really depends on your investment structure objective. Right? And they put it again a P ratio, and then split it to the PVGO. So it's another formula. They flip it. Essentially, what they want to do is they try to come up with a mathematic way to find out what is the growth. What is the growth of the price for that growth for that company? And of course, there's another angle you can see. It's called the retention ratio of plowback ratio. Plowback, which is called the B, small letter B. Plowback means how much money the company will retain itself in retained earnings and then reinvest. And I like that because this is the part that, hey, I gave the money to you, I invest the money to you, and hope you invest for me. So B is, well, at least for me, I will look into that closely. How much money will fall back? So you can see if the fallback ratio is high, then all the numbers will be much higher. You can imagine. So this is why I like company not paying dividends because they have their own reason. Another gentleman that you need to be aware of, but he is pretty old already. Peter Lynch. He was considered as the fixed income king. So if you consider Warren Buffett the best kind of the investment, then Bill Gross. I'm sorry, Peter Lynch. Peter Lynch is for the fixed income. So he is really good at fixed income. So he said something like, hey, if the P ratio of cocoa is 15, then you expect the company will grow about 15% per year. But if the P ratio is less than the growth rate, then you may find yourself a bargain. So this is what he says. So you can see how they how his investment philosophy is. One up on Wall Street. So you can check out the book. So people will start to link the P ratio and the stock price and how they interchange with each other. So you can see the P, the price, and the earnings. Again, all these are just mathematics playing around the variables. But one important direction I want to show that to you is fundamental analysis, not just really like BS a lot of time, not just randomly say something, but they would try to come up with some concrete numbers, some concrete formulas to explain to you. So the bad thing about the good thing about the PE ratio is you can actually still use PL ratio to do a lot of adjustment and then expand that and then see how the company perform. But the bad thing about the PE ratio, which I totally agree, is that it's earnings management, which means that it can be manipulated. PE ratio can be manipulated. You want a good PE ratio, I can show that to you. It is so super easy to do that. The PE is not reliable. And then and also the choice of the gap. Gap is a general accounting generally accepted accounting principle. Depends on the choice of the accounting policy. Inventory, revenue recognition, tax treatment, all that will affect the gap, and which to some degree will affect the earnings as well, which is the PE. And inflation, that will be a problem, and then reported earnings fluctuate around the business cycle. So there is a lot of a problem with PE ratio. But the good thing about PE ratio is you can use that across all industries. Financials, insurance, industrial type, transportation, software, everyone will have a PE ratio. But if we don't use PE ratio, if we use EV/EBITDA, enterprise value to earnings before interest, depreciation, and amortization. I hate to use that Chinese term, but I don't know. 對息前折扣攤銷利潤，對息前折扣攤銷前利潤10個字 ，10 words for EBITDA. Three only three vocals. But EV/EBITDA is actually one. It's actually the multiples that a lot of professionals will use, not the PE. So in this case, we will switch to EV/EBITDA, and again, of course, PE you can compare industry to industry and even market to market, and S&P and inflation rates. So right now, S&P 500 PE ratio is around 25. So it is actually a much higher than average. And then there are two earnings growth for two companies. Con Anderson, that's a utility company producing electricity. PepsiCo, so you all know PepsiCo. You can see the earnings per share EPS is actually quite different between these two companies. One is a sort of high growth, and the other one is actually very stable. And with that, the PE ratio will be different. PE ratio it will be much higher for PepsiCo and much lower in Con Anderson. And then I include that to you for PE ratios for different industries. Different industries will have a different PE ratios, higher or low. And then there's a cyclically adjusted PE, CAPE, and you can see it is it depends on the Schiller. This is actually a really good professor, and actually he suggests we should use the adjusted PE ratio to solve the problem. Because of different phases of business cycle. We are going into recession, definitely. I mean, for the US guys, we're going into recession, and then in that case, the PE ratio will be low. So he suggests that, hey, we should cyclically adjust for the PE. But again, the PE itself may not be as good that we should follow. And then of course, you can use PB, price to book, price to cash flow, price to sales. Why do we use price to sales? Imagine if you have a company only has sales, and then that's it. There's no, not that they don't have any earnings or any revenues, but they just have a negative, huge negative numbers. For instance, pharmaceutical company, biotech company, they may have $100 sales, but then $20 million expenses. Can you evaluate PE ratio? No, PE will be negative. It's impossible. Then in that case, what should we do? We evaluate the price of sales, and sometimes not just in terms of sales, but in terms of the expected sale. Which one is a good company to do that? Sangtong. It's not negative numbers at the bottom line. Then you can use the PS. 5 billing, you say. They have a huge negative number, net income. What should you do? Use the price to sell. Use the price of sales to compare to a similar company. Then you're able to do the apple to apple. So this is how you can use multiples. And then you can compare that, let's say, to yourself or to the industry. So this is how you should do. And then the last one. So I have explained to you there are 3 different subsets for fundamental. First one is using the CAPM, the regression model. CAPM model, the French like the multi-factor model. The second one is the DDM, which is I don't think it's more like a very appropriate model. But the third one is very important, the free cash flow model. This is everything and everyone talked about. How do you calculate the free cash flow? And all you need to do is using your statement of cash flow statement, and come up with 3 different parts: operating, investing, and financing. So think about this. Take a step back. When you run a company, you have the income statement, very nice. How much you make, and then what the cost is, expenses, and then you get a bottom line. And then on the other hand, you have the balance sheet. This is what your bank shows. How much asset you have, and who chips in to fund your business. The bank, the debt holder, and equity holder. But then the problem is, there's no way you can link your income statement and the balance sheet. There's no way you can link. You can see the operation as a whole, for the income statement and the balance sheet, because these 2 statements cannot be combined. And this is the beauty of it, because no one knows how to combine it. And if you're able to combine it and generate the cash flow statement, you win. In a cash flow statement, you basically combine 2 balance sheet and 1 income statement and make 1 cash flow statement. When you're able to make 1 cash flow statement, you can actually put all the accounting items and split it into 3 different groups. The first one is operating activities. How much cash flow your company generates. The second category is, let's say you generate your cash flow. How much money are you going to put to investment, so to fund your future business? Remember this, that the second step, investing, is very important. If you see a company is 0 in investing, I'm basically will just like get off it, because it is not going to help me to. This company is not investing. Then why do you want to invest? But that comes a problem. Let's say if the company makes an earning, through earnings, $100, and the investment is $150, would it be a problem? $100 earning, $150 you have to invest. Yes, it could be a problem, but it could be temporary problem. How do you fund that $50 extra? That $50 will be the financing activity. You raise the debt. You raise from IPO. You will be something like Ling REIT, Ling. You raise from the equity holder. Get the money, fund your project, so that your operating activities will have a money generated. So you need to think about these three sessions carefully. And I'm telling you this, none of your accounting professor will tell you how to use this, because I know all of them here, at least in HKMU. They know how to create that, but they don't know how to use it. And even the finance professor here, I don't think there will be anyone here who will be able to teach you how to do that, including our department head. But this is actually what I do for my life for pretty much in the last 20 years. Now close to 30. This is very, very important. If you're able to understand the logic behind, this is the key. Next year, well, you probably will forget my name, but next year, when you're taking 328 entrepreneurship, then by January, you'll remember, hey, some guys say something about cash flow statement. Because in your 328 assignment number 2, I can actually project that, and you will create your own cash flow statement. You run you have to find and you have to fund your business. And how do you fund your business? Because you need your money is not sufficient. Your money generated by the operating is not sufficient, because your operating activities can only give you $70, but you need $150 in the investing. Where did you come up with the $80? Financing. Can you always use financing to do that? No. The bank will not let you to do that. The equity holders will not let you do that. You see how Link REITs, the price dropped so much. You do that kind of funding, it's not good. The best way to do funding is use your own money, which means you use the money generated from the operating activities and fund that to your investing. So if this is a good company, your operating activities shall be able to cover your investing activities and keep rolling. This is how you can see if a company generating any value. So if mathematically, of course, I'm not going to ask you to do that in the quiz. Not that complicated, at least. But you can see that the free cash flow formula is very straightforward. It will be the true earnings, EBIT, earnings before interest and tax, after tax, plus the depreciation. Why do you want to add back the depreciation? Because depreciation is an expense that is non-cash expense. You didn't pay for it because you pay already. So you add it back, that's your true earnings. And then here, subtract the capital expenditure. That is the investing part. CapEx is the investing part. Because think about this, if you are a car manufacturer, you use CapEx to build a factory so that you can produce more cars. That's investing. But if you have built a factory already like 2 years ago, then you don't need to do that. Then your CapEx will be zero. Then everything you make will be a positive free cash flow, right? What about the last one? Changes. So that triangle is changes in net working capital. What the hell is net working capital? Net working capital is the difference between current asset and current liability. What is current asset and what is current liability? You think about this. You think about Amazon. I explained to you the case before. Current asset is the total amount that you get from your customers, doing all other stuff. But imagine entire current asset is collection from the revenue, the sales price you get from your customers. Current liabilities is the part that you pay the suppliers. Assume everything is simple. That part changes in net working capital means that how much you get from the customers and how much you pay to the suppliers. If you're able to manipulate this good enough, you get a huge free cash flow. And that's why my partner was the portfolio manager. He recommended to buy Amazon back in 2012, 2011. Heavily loaded with that Amazon. And that proves correct. Because when you read income, the net income, it was a negative. So when you read the free cash flow, this part is huge. The net working capital. So think about this. This formula, mathematically, it is as easy as you see. But the logic behind, I want you to understand the logic behind. The true earnings, non-cash, which is including depreciation, subtracting the investment, and then subtract the difference between the suppliers and the customers, and then you will get the free cash flow. And once you get the free cash flow, again, present value formula. Get the free cash flow for the next 5 years, and then you get the terminal value, which is V, and then discount that back by the cost of capital, or the weighted average cost of capital. WACC. Once you get that, and then you get the value of the company. Subtract the cash, calculate the cash, divide by outstanding, then you get the stocks share price. The WACC here, very straightforward. It's just a GPA, your grade point average. You have a debt that will cost you 5%, your equity costs you 8%, and then you have 60-40. So what is your cost of capital? 60% times 5%, 40 plus 40% times 8%. That is the cost of capital. So very straightforward, very easy. Then with Darian, this guy, Indian guy here in NYU, he is one of the famous guys promoting the free cash flow. So free cash flow to equity, and then you can see how that value between the debt and also the equity. So I'm not going to go into this, but there is an intrinsic value of the equity portion. But I want you to understand the concept behind it. So comparing the valuation model, PDM is easier to use. You know, you just guess what the dividend will be, and then you discount it back, right? Free cash flow, very hard, because you can see how much accounting items you need to get. And another problem with DCF, major problem. When you do the projection, so let's say all these are projected numbers. You have your final year, which is the terminal value. When you discount terminal value, majority of the discount, majority of the value is actually from the terminal value. So it could be around 50%, even 60%. So in this case, any assumption that is not accurate in here will affect the numbers upfront. So this is the problem with the free cash flow. So far I've covered you so all these things, but you believe this is actually really hard. 5 of your schoolmates analyzing this particular company, Chow Tai Fook, just 3 months ago, they joined the CFA competition. This is the model they built. I'm not going to go up here, but a little bit here. They have the projected cash flow statement. All these are built by them. They have the discounted cash flow all these years, and then discount it back, and then at the end they have to calculate the WACC, cost of capital, and then they come up with stock price. So it's a Vicky, Summer, Rachel, Jacob, and Rick. 5 of them drove in and out for this company, Chow Tai Fook, 1929, not 1929 Hong Kong. That's the number. So how to analyze that? I showed that to you already, and there's a part here to the overview of fundamental analysis. Do the due diligence, build the free cash flow model, forecast model, and estimate all this, and then you get at the end the free cash flow, and then this is how you run the entire fundamental valuation. So anyone wants to do a drill into it, you can see how what's the steps in. This is the appropriate way to run a free cash flow model. So look at what they did. They said they have a compare Chow Tai Fook to some other companies, pair of companies, and at the end, you read on your own. I'm not going to drill too deep. The stock price was trading at 17.44 on January 3rd, January 4th. That's when they make a recommendation to sell. They are the only team, probably the only team doing the sell recommendation among the 20 teams. They joined the competition. The stock price was 17.44 Some people expect that it's going to go up to $30 because of opening of the border. But our team actually make a conclusion, it will drop 20%, close to 20% to 1460. Do you know what the stock price is now? See them. 1374. They were right at the ballpark, and they were the only one doing the sell recommendation. And I don't understand why they failed. They didn't get picked as the champion team. Right on spot. They were at this point here. January 4th here, $17. They make a recommendation after the DCF. They believe that that stock is not going to worth $14. And look at now. And of course, like when you run this competition, there are a lot of things behind. They believe that, hey, that's not good. But you imagine you put this on the stock valuation. By the way, I did put up a stock. My CEO is a good friend of Chow Tai Fook, and he actually asked me, should we buy the stock? I said no, because I do watch the students to do this, and that no, this is expensive, really expensive. So you can see the multiples, the premium. Historical average is 28%. Now it's a 53%. Standard deviation of 1.7 is way too far. And supposed target price doesn't matter which one you use, which multiples you use. It's always lower than $17. You can see the estimated return is 20%, 21%. Every single one of them points to a lower point. I don't understand why all other teams would have made a $20 or $30 stock price, but we make a $14.60. This is the stock price here. And it was $14.60 a few days ago. Now it's getting worse. So this is the sample financial model. When you click here, and you will be able to see how that works. That sample model, a lot of you guys will use in your assignment number 2, in the 328. So that's the aggregates of the stock market. I'm not going to go into details with you for that, but I hope you guys will have some, let's say, some good approach with respect to the of the equity valuation. So let me go over this really quick. I know we are lag behind by close to 1 lecture. I'm supposed to cover equity in only like 2 or 3 sessions at most, but I have actually a couple more than I need. So I hope you guys will learn something about fundamental analysis. Next week, I'm going to go over fixed income, but it will be really quick. Fixed income itself has a lot of more technical or calculation things going on. So I want you guys to hopefully read this first. I will post the session notes early for the next 2 times. So try to read through this and tell a friend to read through this, because you need that for your ICA too. You definitely need that. So I'll go over this, and I will try to reduce the amounts that I need for the last section, which is the hedge fund or the alternative investment. This for the active investment, I will try to reduce this, and I'll push fixed income and options in the next few sessions. Hedge fund and active investment is actually not that applicable, but then there will be only some things that I want you to learn. But for fixed income and options, it is the 2 other asset class I definitely want to share more with you. So let's hopefully we can cover this. All right, that's it. I will see you next Friday. Thank you very much. Was it?